Welcome back to the Mentor Show, which offers quick lessons packaged within minisodes for busy founders and startup leaders like you. I'm Adel, and I'm being mentored live and unscripted by Ed, who's built, sold, turned around, and scaled startups all the way to the New York Stock Exchange. He's based in the US, a developed economy, and I'm based in Dubai, a hub within an emerging economy. And we compare notes. This is real talk, no scripts, no theory. Let's get into it. Back in time, the founder who have founded the company and turned it into a family business because they brought their siblings, their kids. How does the cap table look for such a company? Do they bring external investors? When do they bring them? And if they bring them, how much of the equity they own so that it's still considered as a family business? I'm assuming it's a controlling percentage or share of the business.
It's an interesting question because every business, as it grows, is going to need capital. And you bring capital in through profits if you're very lucky. Profitability can fuel your growth. You can bring in capital through debt, taking a loan, and hopefully the interest rate is something you can make work in your business model. So you're paying off the loan, you have access to money, and you can grow the business faster to repay the debt. And the third option is you do bring in an investment for equity. I think that's a very tender subject because when you sell equity, you are selling some ownership of the business. And whoever buys that equity is going to want, in fact, probably going to demand a voice at the table, even if it's a minority share. Now, in the West, under some accounting laws with Internal Revenue Service, if you sell 20% or more, that has some tax implications for the buyer, the investor. And so if you want to keep the investment as a true minority ownership, you're selling less than 20%, typically speaking. I'm being very general here to keep the conversation simple. But even if I own less than 20%, if it's equity, now my investment is tied to the performance of the business. And unless the business is on an absolute rocket ship ride of growth, I want to be able to have my voice heard in a board meeting. I might not have a board seat, but I at least have the opportunity, whether it's through an email, a written letter, a phone call, maybe participating in a specific board meeting where the topic is relevant to my interest. I want my voice heard. And if you're a family office or a closely held corporation, letting in an outsider with an equity stake is a really difficult thing to do. It's not impossible, but you have to think very hard. Other than money, what am I getting from this investor? Do they know my industry? Do they know customers that they can bring to the table? Is there ways that they can help other than just putting money into the business? Again, if we just to do a quick review, companies growing very quickly, it's family business, profits can fund growth. Profits aren't substantial enough, but continuous. Maybe they can use that to go get a loan from a bank. And if they can't find enough money from a bank, then they can go to the outside investment world and bring in an outside equity investor. But the whole premise here is that you have a good business model, you're seeing good growth, and you need to fuel that growth.
And this takes us back to the concept of an exit. If the founder or when the founder passes away, the kids will become the inheritors and they're sitting on the board. Ideally, they have an external investor with them. That means they will be forced to run it as a corporation. The succession planning doesn't happen through only the family. It could be through an external party.
If they're bringing in investors and the investor has a significant enough influence, that certainly could be an avenue. I would say this, if you invest in a company, whether you're an individual or a professional organization like a venture capitalist or a private equity firm, you use the word exit. I'll use a different word. You have an expectation for liquidity. At some point in time in the future, you expect to have a way of selling your interest for an impactful return. And if I just use general thoughts around what is an impactful return, again, here in the US, if you successfully exit investment through a liquidity event and you return 3-4 times the original money, that's successful. Every once in a while, when you do great and you find a rocket ship business, Maybe you return 10 times the money, right? Those are the home runs. But good investment firms can deliver 3, 4x multiples on the money originally put in a reasonable time frame, typically 8 to 10 years. If they can't do that, it's not a really interesting return on a IRR basis. So how do you get liquidity? If the company is generating huge amounts of profit, you want out, maybe because you're rebalancing your investments, maybe because you, the investor, need the money yourself to do something differently. The company can buy you out through its cash. You could sell your shares to another interested investor if the company allows that, right? They'll have a right of first refusal. Or the business is big enough, it is growing, it is well operated, predictable, and it has the opportunity to go public in a public market. The NASDAQ, the New York Stock Exchange, the Toronto Exchange. I mean, it doesn't have to be in the United States, but those would be the opportunities for liquidity. Right? Company buys your shares, returns your capital, and then some, or another investor comes in and buys your position. They may or may not pay you top dollar. The company's not public. There's no real incentive to do this. But I'm reminded literally last week, there's a good friend of mine who is an individual investor. He's an angel investor. He had put money into a private company about 5 years ago. And the time came literally last week for a new round of investment to go into the business. And he didn't have the money. So through a lot of conversation with the large institutional investors, one of the institutional investors is so excited about this business that they effectively went out to all the minority shareholders and said, we will give you 2 times your money for your investment. We'll just buy the shares from you directly. And so the institutional investor got a larger piece of the business by paying a 2x multiple on a fairly small amount of money, small for them relative to their fund size, but the small investor got a 2x payday. Good for everybody. Sometimes those things can happen.
And I'm assuming that the investors did that because there is some kind of internal synergy with their portfolio companies, or?
That's correct. They believe in the sector. They like business. They believe it's going to get much, much, much more successful in the near future. So this was their reason to make it easy for all the small investors that did not have the additional capital to invest to exit gracefully. So it was a win-win for everybody.
By doing that, they are influencing the company, right? So the intention is to maybe acquire later on a major stake within the company and merge it with some other portfolio company.
That's an option, certainly. I do think that when an institutional investor invests money in your business, their intent is to find a way to help you grow. They're interested in the business because of you, the CEO. They're interested in the business because of the team you assembled. They're interested in the business because of the business model and the sector that your product or service is addressing. And they like the growth characteristics that you're, putting down each month, each quarter, semi-annually and annually, right? You're doing all the right things. At that point, it's not about, telling the CEO what to do. It's about having a mature voice at the table in a board meeting to say, hey, have you thought about X, Y, and Z? Have you thought about expansion? Have you thought about raising more capital to take advantage of market opportunities that are in front of you? So it's about positive influence, not about negative control.
That's it for this minisode. Big thanks to Ed and to all of you for tuning in. If this sparked something, hit subscribe so you don't miss the next one, and make sure you share it within your network. Got a question for Ed? Drop it within the comments. See you next time.
Please note, the views and opinions expressed in this podcast are those of the host and guests and do not necessarily reflect the official policy or position of any affiliated organization. The content provided is for informational purposes only and should not be considered as professional advice. We encourage listeners to conduct their own research and consult with relevant professionals before making any business or career decisions.